I want to show you how to build wealth through your own debts and expenses. And I want you to be the one profiting from your debts, not the credit card companies, the banks, and everybody else. All right, wish me luck. Oh, that went well, really well. Well, the thing I've always learned is if you don't succeed at first try again. But let's not do that for your wealth and your debts. Let's just get into it. Come on. Welcome back, everybody. Wealth webinar in full effect. We've been doing this show 7 straight years, and here we are. Thanks for joining us. Today, we're going to do something really fun. We're going to talk about debt recapture and how it works. But specifically, one of the things that we see a lot is we see a lot of people that are trying to build wealth, but they've got debt. And they look at debt as a problem. That's the biggest thing they say. Oh, my debt, my debt, my debt. I can't do this because I got too much debt. What if debt wasn't the problem? Because that's the thing. Debt really is not the problem. It's who's profiting from the debt that is. Let that sink in. Like, debt can either be one of two things. It can be the best thing ever, because think of it. If you were a bank, you'd want debt, right? You wouldn't even exist as a bank. If you owned your own bank, you wouldn't even exist if you didn't have people in debt, because you'd need car loans and mortgages and credit cards and home equity lines, because that's how banks make money. But you see, as the consumer, as the retail investor, as just the individual, debt is viewed as a bad thing. But it's only viewed as a bad thing because we look at it as an expense, because we're not profiting from it. And I think that's where we got to frame this thing. We got to flip it upside down, and you've got to look at this as you are the bank. And I'm going to show you many different things and different ways to structure this. And Craig will be joining us on this to show you the Vault software. If you have not seen the Vault software, please go to BYOBvault.com. We'll put that in the chat and on the bottom of the screen here. That is our revolutionary operating system for you to be your own banking system. Because I know what we found is a lot of people, when they get into this, they're like, yes, Chris, I want to learn how to turn debt into wealth. I want to build wealth through my own debts and expenses, but I don't know how to. And then we do a video or 10 videos or 1,000 videos. We show them how to do it. And they're just like, I don't know. It's too complicated. Or I don't know. I lost track of the spreadsheet. What if it was like a GPS in your car? When you want to go somewhere, you just put the destination in. The destination today is how to recapture the money I'm giving away, how to build wealth through my debts and expenses, how to pay off all my debts. Those are your destinations. You put those into the vault, and the vault does all the work, just like your GPS does. You put an address in, and it takes you to that address the mathematically most efficient way. The vault's going to do that. If it's paying off debt, buying cars, using it to invest in real estate or private lending, this software will automate or operate your private banking system. And we'll show you that in a little bit, but I want to first kind of do it the old-fashioned manual way. So first, from the chat, I always like to see who's here for the first time. So if you're here on Wealth Webinar for the very first time, if you could put I in the chat. I like giving some shout outs to everybody. So we got a bunch of folks here for the very first time. I want to give a huge shout out to each of you. Sorry if I messed your name up, but I love that all of you are here, because that means you are all part of the 5%. You're all here because you're willing to invest your time, your energy, and, in this case, you didn't have to spend anything for being here, but a lot of times you would be the one that would be willing to invest your money to learn something new that will put you in a better financial place. And I commend you for that, because, listen, you're very different than the rest of them, because the rest of the folks are out there. They're the conformers, right? The 95%. They conform to what everybody tells them to do. So we're going to show you what the conformer looks like, okay? The person who just does what they're told, who follows everything they've been taught their whole life and just says, this is the only way, I was born into this, blah, 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 blah. They said I should do it this way. But all of you are creators, and I love our creators. And you know what? We got a lot more than just the newcomers. We got all the people who have been here a bunch of times. Travis just said third time. We got Christian here, like 9,999, it might not be 9 trillion, but 9 billion. We got Tess coming in with an additional 9. Got Frank, Maureen, yep, Lucy, Dex, a lot of familiar names. So if you've been here more than once, you're probably familiar. And it's kind of funny, and I guess we're really honored. Stephen and I have been doing this show now for 7 years, every single Wednesday at 1 o'clock for 7 years. Let that sink in. That's a lot of time, right? So we've put the time in to teach all of you. And the biggest honor we get is when people just show up year after year, month after month, week after week, day after day. That is the biggest honor to us. So commend to all of you. But also, let's just kind of get right into this debt. How many of you, and this should be 100% of you, but how many of you during your lifetime have financed a car? Put car in the chat. How many of you have financed a car in your lifetime? Just so you know, leasing is financing. Yeah, it should be about 130 of you, right? So that thing's just going to keep blowing up. Now, how many of you plan, this is a trick question, okay? So hear me out. How many of you still plan to finance cars in the future? I want you to write future in the chat. This is a trick question. How many of you still plan to finance cars into the future? Okay, Morgan, Sonia, Robert, some of you were like, oh, you said it's a trick question. Good, so I love it. Tara said self-finance, Back to the Future, got it. Okay, I love it. Through my company, through my own bank. See, you guys are picking up on this. We don't want to change what you're doing. About 100% of you have financed a car in your lifetime. And it doesn't even have to be your car. It could be your kid's car, your parents' car, your wife's car, your husband's car. It doesn't matter. You've financed the car, and you're going to continue financing cars for the rest of your life. That's the bad, but the good news. What we're going to do is we're going to change one thing and add one step and allow you to profit from financing your cars. How many of you want to profit from financing your cars? So you're going to buy cars for the rest of your life and not get around that because you need to get to work, take your kids to school, do all those things, grocery shopping, nails done, hair done, yada, yada. But you're all going to need to get there. And I doubt any of you are riding bicycles where you're going, especially in the dead of winter. Although many of you will see the intro to this video when we launch it. I was outside riding my bicycle and it did not end well. It's slippery, it's icy, and bicycles, yeah, not the most ideal thing. So stay tuned Saturday when this wealth webinar posts up to the YouTube channel. You can see the intro of the bicycle in the snow accident. Yes, whatever you want to call that. All right, so with that being said, the fundamentals. That's what we got to get into right now. We got to get into some debt recapture fundamentals. So if you're going to continue to finance your cars, but you're going to be the bank, you're going to be the one profiting from financing your cars, why would we stop at cars? Who can tell me what else you finance? What other things do all of you finance? Put it in the chat. Dex is financing his bloopers. Okay, that's great. An RV, appliances, a house, anything. You see, we could go on like this all day long because really everything can be financed. And the best part about that is we're not going to ever just stop at cars. We're going to move on to everything. You're going to continue to finance things through the rest of your life. However, I want you to take this and I want you to listen to this. This is from the late R. Nelson Nash out of the book, Becoming Your Own Banker. He said, you finance everything you buy. And you do. You finance everything you buy because you're either paying interest to somebody else, or this is the best part, or you're giving up interest you could have earned. You're either giving somebody else interest for the things you buy, or you're giving up interest on the things that you buy, or giving up interest on the money that you used. So that's what he says. So we call that opportunity cost, okay? When you give up interest that you could have earned, that's called opportunity cost. And all of us, myself and Stephen and Craig included, we are all guilty of giving up opportunity cost. Now, let me give you an example of how that opportunity cost can be given up. You have money, and I'm just going to pick on a traditional bank. You have money that you saved in your bank account. Let's just call it XYZ Bank. And your bank account is paying you 2% interest on your money. Okay, so you're making 2%. Now, I know that's not a lot, but you're making something on your money. So you're not losing opportunity cost on that money when it's in the bank. But then all of a sudden, you get the opportunity to invest in this coaching program that's going to allow you to make $1 million. So you take the money from, and we're going to call this education, okay? But notice I didn't say traditional education. You're going to take the money from that bank that's paying you 2%, and you're going to invest it in this education, this coaching program that you're going to buy. Now, that coaching program is successful. You learn, you get coached, you go off, you make $1 million. You made $1 million, but what did you give up? Okay? You gave up the interest you could have earned. So that money that was sitting in that bank account that was earning 2% no longer earned interest because you took it out and you invested in your education. Okay, we could change, we can do that a million different ways. You took the money from that place and you invested in appliances, you invested in an RV, a vacation home, a car, a business, all those different things. Notice how it's all the same equation. The opportunity cost was the 2%, but make the 2% 5%, make it 10%. It just depends on what your money is actually earning. That's the opportunity cost you give up. And that's exactly what we're taught to do. We are taught to save our money, and then we're taught to spend our money. But what has happened over time, especially right now, and I can't imagine it getting better, is credit has been introduced. Now, credit didn't really exist to the capacity it does today in the 40s and 50s. Most people paid cash for things in the 40s or 50s. They didn't finance their appliances, their cars. You know, they rarely financed their houses, for crying out loud. Some of you are old enough to know that. You saved up money and you paid cash for things. That was the way. But you still financed every one of those things. Even though you paid cash for them, you financed them because you gave up interest you could have and should have earned on that money. Everybody tracking with where we're at? Now let's go back to what I was started with. Debt is bad. These are the things we think, right? Debt is bad. So if you don't want debt, what do? You save up and you pay cash for things. And I noticed in the chat, some people said, I'm going to pay cash for that. So that's what we do. If debt is bad, because we're taught debt is bad. Dave Ramsey said debt is bad. So then what we do is we save up cash and we pay cash for things. But most people, you know what the equation is for that? Most people, they sit here. Let me just draw it. Most people, this is what that looks like. And you've seen this chart, but I just like giving it a visual. They save, 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 save. Okay. Then they buy something and then they're back to where they were. Let's just say this is a straight line. Okay. So this straight line represents 0. We'll call this baseline. So this is your baseline, which is 0. You have no debt, but you have no savings. You save up, you got 10,000 bucks. You find a used RV, you buy that RV. Awesome. You're back to 0. Then you start saving, 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 saving. You save up 20 grand. You buy a new car. Okay, so this is a car. Over here was an RV. I don't know why we're going RV to car, but whatever. Okay, so you're back to 0. Save, 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 0. This is what we do. Now, that's one equation. That's the cash buyer. What did you give up there? Well, you gave up the earning potential on 10,000, 20,000, and 40,000, respectively, because you constantly went back to 0. This is how most people operate now. Okay, they save, 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 but then they borrow. So then they borrow and they borrow and they borrow and they get themselves in debt. This is a terrible drawing, but you kind of get what I'm saying. So that's what most people do. But what we want to get you to do is we want to get you so that this is what your saving curve looks like. But in the middle, you're still going to finance, but you're never going to lose the opportunity cost. Your cash, your money is always going to earn for you. So you're never, ever going to give up opportunity cost. You're still going to buy things, but as you buy things, the interest that you normally would lose, okay, so let's just kind of do it this way. Or actually here, we'll do it this way. We'll do this, and then we'll kind of build it back like this. Imagine if you didn't have to do that. Imagine if everything you financed, all it did is added onto your wealth. So you take a loan out, you finance that loan, and now all of a sudden your wealth goes like this. And then you do another loan. See, this isn't how it's supposed to work. Loans aren't supposed to build wealth, but what if they could? Because they should. And that's what R. Nelson Nash talks about. He says you finance everything you buy, you either pay interest to somebody else or you give up interest you could have earned. So what if we can earn interest on our money while still buy all the things we want using financing, but the interest on the financing comes back to us, at least the spread, because that's how a bank works, right? Banks basically pay you 2% and then charge you 6%. This is what they pay you, if you're lucky, This is what they charge you. I just looked today. Used car loans are right around 5.49 to 6% with perfect credit. So if they did this, the bank made a spread of 4%. So we are trying, you are all here, I have to guess, to want to learn how to be your own bank. Well, if you want to be your own bank, we need to understand how banking works, which this is how banking works. They pay this, they earn this, they charge, that's theirs. This is called a spread. We have to become really, really good at earning a spread. And that isn't very hard. You don't even need to do anything to earn a spread. You just need to change where your money goes first, and then you need to change how you use your money. The single most important thing, which is what I want to get into today, how you use your money. But let's go back to these thought processes. Debt is bad. Okay. Second debt process. Interest is the enemy. Interest is not the enemy. Interest is your best friend if you are the one profiting from the interest. See, it's just a simple change. You're just changing one thing, framing how you're looking at it. Interest is the enemy. Interest is my best friend because interest is what I'm getting. See, we both are on two sides, but we've been taught to really focus on interest as being bad because we pay more interest than most of us earn. And that means we're not making the spread. That means we're on the other side of the coin. Somebody else is profiting from our financing activities. And just so you all know, and some of you should write this down, and if you could put this in the chat, the infinite banking concept, by definition, is the process of taking back the banking functions in your life. If you could write that down. The infinite banking concepts, by definition, is a process, not a product. It is a process of taking back the banking functions in your life. Let that sink in. If you took back all of the banking functions, which means you took back who you pay interest to on every loan you have. Let's just say over a process of time or a period of time, you pay yourself the interest instead of paying Visa and Amex the interest. Step one. Step two, you take back control of your car loan and you no longer pay XYZ Bank a car payment, you pay yourself a car payment. You do the same thing when you start your business. You self-fund your business, but on the books, your money you put into your business is a loan. Your company has to, and this is an IRS rule, you can look it up, talk to your CPA, I'm not giving you tax advice, but you have to pay yourself back with interest. I can't remember what it is, 3 letters. Basically, there's a rule. You have to pay yourself back with interest. So you start your business with a loan you make to the business, and then your business, when it starts profiting or making money, pays you back with interest. How cool would that be? You know how many more people would want to start businesses? But the problem is we have all gotten so trapped in the debt cycle of having too much debt that we have not saved money. So when we want to do anything, buy a new car, finance our child's education, buy new appliances, buy a new bedroom set, buy a new vehicle, we don't have the capital. So we always go to the bank with our tail between our legs. I know we don't have tails, but just envision that, and ask them, can I borrow some money? And we use their money. Therefore, we put them in control. We pay interest to them. We lose the financing game. Now, I know that's not easy to create your own banking system, and it's not easy because it takes time. It is a marathon. And that time is only, the reason it takes time is you have to capitalize your banking system. Now, I have to believe, and I don't know this to be fact, but Bank of America, one of the largest banks. In the beginning, when Bank of America, it was just an idea. Hey, we're going to start this bank. It's going to be called Bank of America or whatever the hell it was. And what do we have to do? Well, we have to capitalize the bank. No bank operates or starts with zero money. They have to have money. I know this because I have a friend whose father owns a bank. And I know how the charters work. You need to have some capital. You need to have capital to capitalize the bank. Once the bank is capitalized, yes, then you can go to the Fed. But I just want you to understand, there's not a single bank anywhere in the world, as far as I know, that did not have to be capitalized first. Why would your bank be any different than Bank of America, JP Morgan Chase, Ally Bank, or any bank you can name? Why would you be different than them? You're not. So that's the problem. We have to capitalize your banking system. We have to start from ground floor, which is zero, and we have to build up your banking system. Now, there's ways to do that, which we can show you, but I wanna get into the key idea of today's training. And I've got a really cool diagram that explains this. We're gonna talk about debt recapture. Now, to some of you, that doesn't mean anything, right? Debt recapture. How many of you know what that means? Debt recapture. So let me just give it to you. It is not about eliminating debt. So those of you that thought debt recapture is about eliminating debt, it is not. Actually, when you talk about debt recapture, it would make more sense for you to have more debt, not less, more. Debt is the way. Debt means you're building wealth, not losing wealth. So we need to change the framing and our mindset around how debt works for you. But remember, we have to act as if, write this down, please, act as if you are the bank. Okay. It's about redirecting interest flows to you. That's what it's about. It's about redirecting interest flows back to you. So when you use an IBC policy, I want to just kind of show you this. So this is how everybody treats debt today. Okay. Everyone pays for their debt. And it works something like this. You go to your job, you make an income, or you have a business, you make an income, or you have a side hustle, you make an income. Out of that income, some of that income, and this is never going to change, is going to go to expenses. Now let's leave debt payments out of that, but let's just say expenses, like you got to buy diapers, you got to eat food, okay? You're going to have to, there's various things, toilet paper and paper towels, like those are all expenses, utilities. Those are your expenses. That money's gone. But then most of you, I think almost every one of you that are on here, because we've done a poll, we did a survey to ask about our audience, and we've got thousands of clients, and we've asked them, how many of you save money? And it was almost 100%. So I already know all of you are saving money because you already told me. There might be a few that aren't saving money, but we'll change that for you too. So the savings is your income minus your expenses equals your savings in most cases. So today, where does your savings go? Well, I'd have to guess your savings is going into the bank. But is this your bank? No, this is someone else's bank. Okay, so let's change this. This is not your bank. So I'm just going to write not your bank. That's all you need to know. You are putting your savings in someone's bank, but it's not yours. And they're hopefully paying you interest. But then what are you doing? You're going to that bank and you're accumulating debts, maybe from this bank or others. So then you got these debts over here on the other side. I don't want to combine these. I want these to be separate. Then you make payments on these debts, okay? But that payment means that that money leaves your family forever. Those payments on your debts are gone forever. This is where 95+% of the people out there operate. And they wonder why they can't get ahead. This is the flat line, right? They save, gone. Because it doesn't matter. This system is rigged against you. I think you can see that because you've got expenses. All of us have expenses. So the only way to make more or to save more is to increase your income or decrease your expenses. And I think all of you are probably pretty good at one of those two things, maybe even both. You're really good at maximizing your income. That's just our audience. We have a very affluent audience. You're good at maximizing your income. You know how to make money. Okay. You're also probably pretty good at reducing your expenses. I mean, we're all in control of our budget. We can kind of move some levers. We can spend less, spend more, enjoy less, but we're in control of those, which then equals our savings. And that savings is coming over here. But in order to just operate, I think, Stephen, Craig, I would almost have to say that in today's world, it's near impossible to live in society without debt. Do you think that's a true statement, Stephen?
Yeah, it's very, very difficult. That's for sure.
I mean, without knowing what we're going to teach, but for the average person that doesn't know how to be their own bank, it'd be pretty near impossible to live and operate in today's society without some form of debts. And we can
even with what we teach, I mean, even a home mortgage is considered debt. I mean,
yep.
If you want to own a home, you're probably going to at least incur some of that debt. And then there's the fact of there's some good debt you may want to incur to be able to use some strategies. So debt can be used in positive ways as well.
Right. Okay. So now let me just show you how we change this dynamic. It's a very simple drawing. For many of you looking at this, it should look very different. Remember the old one that we just looked at? When we went to the debts, the money from the debts left your family forever. Okay? It was gone because you made debt payments of interest and principal. That interest and principal left your family. So when you become your own bank, okay, when you use the infinite banking concept, which the infinite banking concept, I want to be clear, is this little circle that goes all the way around the process, because that's all it is. I just want to be clear about this because a lot of people confuse this. IBC equals a process. That is it. And it does not have to be anything to do with a product. But now let's layer in a product because it's more efficient mathematically. And when Craig comes on and shows you the Vault software, which we're going to, and again, I urge, and listen, how about I just tell all of you something? Like, we go through life and people tell us what to do and we do it. Your boss tells you what to do. Heck, maybe you've got, maybe you run your own company, but you probably have a CFO that tells you, the owner of the company, what to do. I've got one of those. You also might have a Shauna who tells you what to do and you listen. You might have a Steven who sometimes tells you what to do and sometimes you listen. But you have people in your life telling you what to do. So we are all very accustomed with being told what to do. So I'm going to tell you what to do right now. You may not like hearing it that way, but I'm going to tell you what to do because this is in your best interest. You are going to buy the Vault software. And I'm going to tell you why in a moment, but because it's going to put money back in your pocket that you don't have to work harder for, longer for, or take on any risk for. Oh, is that enough? You will make money, but you have to spend money to make money. So buy the Vault. And you do that by going to BYOBvault.com. Now, I've never on this show been that forceful in selling something. But you know what? I'm the type of person that if we are, this happens all the time. Let's just say we're at an event and we're chatting for the first time. We meet at a private money club, money tank event. And we're just chatting it up. You're asking me questions. We're just going back and forth. And I noticed that your fly's down, okay? Your fly is down and it's kind of just, you're breezing out there. There's a lot of people that would see your flies down.
Oh, flies down, what should I do?
And they're so caught up in the fact that they're seeing the fly open that they're not even paying attention to the conversation. Okay? That's a lot of the people you're going to come across. How I operate, maybe this is a New York thing, is I'm going to be like, hey, hold on a second. Hey, your fly's down. And you're going to go, oh, I didn't know that. And you're going to zip that thing back up. And then we're going to carry on the conversation. Now there's no disruption in the conversation. I was honest with you. Maybe you had a moment of embarrassment where you're like, oh my God, my fly was down. Was it hanging out? Like, anyway, you get the drift. So I'm just a direct person. And I'm being direct with you, but I'm being direct because I care. And I would have told you you had a booger hanging out of your nose. I would have told you you had something in your hair. I would have told you your fly was open because I'm kind of that honest person. And I know it's in your best interest. Because if I don't tell you, 15, 20 other people you talk to are going to see that your fly's down. They're not going to tell you, but then you're going to become the talk of the event.
Oh, yeah, I just got done talking. Somebody's got to tell him to zip his fly up. Yeah.
That's just, we live in a soft world, don't we? We live in a world that I like to call it of weak people that won't tell you you have a booger hanging out of your nose. They don't tell you that your fly's down. They don't tell you that you got something funky going on in your hair. Maybe you put gel in your hair or some pomade and you forgot to rub it in. So you got this giant chunk of clay in the side of your hair that everybody's going to see except for you. So you need to buy the Vault. That's what you need to do. It's not expensive. $19 a month, $490 a year for the portfolio plan. You got to buy it. And I'm going to show you why in a moment, but just trust me, I'm doing this because I care about you and I care about your family and I want you to be in a better financial place. And to get there, you got to spend a little bit of money. I just did something I don't think I've ever done on this show. Stephen, I don't know, have I ever done that? Have I ever told people they have to buy something?
I can't remember.
I can't either. 7 years.
It's been a while.
Did I offend anybody? Was anyone offended because I told you have to buy something today? I don't think I offended anybody. I mean, maybe somebody was like, well, I didn't come here to buy something. Maybe that, but you weren't offended by me telling you that, right? Good. Because if I ever see you at an event, you have spinach or something in your teeth, you got a booger hanging, you got a fly down, come see me. I promise you. I'll tell you. And nobody else probably will. All right, well, let's get back into this, okay? The difference is when you become your own bank, You change where your money goes first. So this is the one change, okay? Right here, one change. We're not going to put your money in a place that is rigged to beat you, in a place that is rigged against you, in a system that is rigged to take from you, not give to you. And that system, I hate to tell you, is our banking system in this country and this world. They are rigged against you. So we got to change where our money goes first. And we're going to put our money in a very non-conventional place. But we didn't come up with this. Stephen didn't one day be like, oh, Chris, I think we should just start telling people to change where their money goes. No. We learned this because the banks did this. The wealthiest families. I got a video called The History of IBC that shows you all the families. I mean, Ray Kroc, Walt Disney, Rothschilds, Rockefellers, the Morgans, yes, the JP Morgan founders, the Stanleys, another banking family. They all used this place for their capital. And that place, many of you already know, is your banking system. But your banking system is a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. If Dave Ramsey heard that, well, he might just have a heart attack. And I don't know. Maybe I'd feel bad if he did. Maybe I wouldn't. But he would have a heart attack or an aneurysm or something if he heard me say, you should put your money in a whole life insurance policy. But if you heard about why you should do this, it would start to make sense. So let's just hit some of the whys, and then we'll get into the rest of this, and I want to go fast after that. Some of the whys. The whole life insurance policy, and more specifically, the mutually owned, very important, life insurance company is mutually beneficial for you. Mutually. The insurance company, when they become profitable, they share those profits with their policy holders, their policy owners. You, as a whole life insurance policy owner, they share. Look it up. Go online right now. Go to your favorite AI and ask, how does a mutually owned life insurance company benefit policy owners? And you'll very quickly find out that as a mutually owned policy holder, a mutually owned life insurance company policy holder, you're technically an owner of that company in a roundabout way. You participate in the profitability of that insurance company through dividends. So the insurance policy pays you contractually a guaranteed interest rate. Your bank, you might think, pays you a guaranteed interest rate, but it fluctuates. It can change. The insurance company's guaranteed interest rate never, ever changes. It is locked in stone in a contract form, and that number varies between 2 and the highest that we have is 3.75%. But I'm just going to keep this simple for today, and I'm just going to call it 3% because that's just easier to remember, okay? Guaranteed interest of 3%. How many of you have a bank account right now, a high-yield savings account that is paying you more than 3%? Put I in the chat and tell me how much you're making. So we do have some people that found high-yield savings accounts that are paying more than 3. But hold on. Remember I said they give you a contractual guarantee of 3%, but because you're a policyholder of a mutually owned life insurance company and you participate in their profits, so they pay you a dividend. So the lowest company's dividend crediting rate we offer is 5.9%. But now an insurance company with their dividend crediting rate, now although the dividend is not guaranteed, okay, they have never not paid one. And just so you all know, that 5%, Tyrone's 4.95, that is not guaranteed either. As soon as the Fed drops interest rates again, then your interest rate will go down. So when I say this, 5.9, of the 5.9, only 3% is guaranteed to never change. But today we're at 5.9 on the lowest that we have with the insurance companies. But hold on a second. Tyrone, I'm going to pick on you. You're making a good rate with your bank, 4.95%. At the end of, like in January or maybe early February, tell me, did you receive a piece of paper from that really good bank that's paying you 4.95%? And it was called a 1099 INT. Did you receive one of those pieces of paper? Or Robert's getting 5%. Did you get a 1099-INT? Tyrone said yes. Tyrone, you know what that is, right? That is a tax document stating that you made interest on your money, and therefore that interest has to be taxed. So did you really clear 4.95%? No. You cleared 4.95 minus the taxes you pay on the interest. But over here in the whole life policy, you earn 5.95% gross. Now, granted, there is a cost of insurance, okay, for the death benefit. There is a policy service fee, usually $50 or $100 a year, depending on which company. And then there is a commission paid to us for setting up your policy, which, yes, our commissions are reduced by 60 to 90%. That's how we design them. But nonetheless, I'm just keeping it simple. These policies, if designed properly, are tax-free. So therefore, the 5.9 gross dividend crediting rate that you earn, you will not get a 1099 INT. Have any of you who own a policy received a 1099 dash INT? Anyone? Any of you that have a whole life policy, have you received a 1099 dash INT? No. And that makes sense. You would not receive one of those. But not only that, it is protected against judgments and liens in most states. So I'm just going to write protected. Your bank account is not protected unless it is owned by a trust. And not only that, does Tyrone's bank account, sorry to pick on you, Tyrone, but it's fun. Tyrone, does your bank account pay a death benefit when you die? So let's just assume, Tyrone, you had $5,000 in your bank account. If you die tomorrow, does your family get more than $5,000? Just checking. I mean, maybe you got a really good bank. I don't know. Tyrone said no. Does anyone have a death benefit associated with their bank account? So when you die, does your family get more than what's in your bank account? The answer is no. We don't even need to do that. I'm kind of tricking you. But here with the whole life policy, yes, there is a death benefit that's paid out. So if you care about your family, your kids, your wife, your husband, then the death benefit's pretty important. So all I'm trying to do here is not spend a lot of time on the product, because I really want to talk about the recapture process. But we did need to have that discussion, just like we needed to have the discussion about your fly being down and the boogie hanging out of your nose. We needed to have this discussion because if I didn't tell you why we use a whole life policy, you would think we're trying to scam you, right? You would think we're just doing this to make a commission. But I can articulate mathematically using the Vault software, that software I told you you have to buy. I can articulate how this mathematically makes more sense than doing it from any bank account, anywhere. Okay? So, but now let's move on, because this is not important for this point. That was the one change. Your savings is going to go into your banking system, which is a specially designed whole life. Now, over on this side, we've got your debts, okay? And I'm not going to use any numbers here, but what we're going to do is when the money comes into our banking system, which is our savings, we are going to reposition our savings to take back the banking functions in our life. Now, this is only for those of you that have debts. And debts could be a mortgage, it could be credit cards, it could be lines of credit, it could be appliance loans, it could be car loans. All those qualify. The Vault software will put them in an order that is mathematically sound and proven to pay it off the fastest way. But here's what we're going to do. We are going to reposition money from your banking system to pay off their banking system. So we're going to take our money out of our banking system. We're going to do it in the form of a loan, okay? We're going to take loans from the insurance company. The insurance company is going to charge us interest. Now, I'm going to go really high. Matter of fact, actually, I got some really good news. And the team knows this, but all of you don't. We work with this one insurance company that many of you are familiar with called One America. And I'm really happy to announce that their loan interest rate starts, drum roll please, with a 4. Once again, that is correct. The loan interest from that company's policies has a number 4 in front of their loan interest rate. But for today, I'm going to show you 6% loan interest rate, okay? So now we are taking loans from the insurance company at 6%. Our money is over here in the policy earning 5.9%. And actually, let me make this simple because I want to show a spread. So let's do 5.5. Actually, let's just do 5%. This will make it easier. So we work with 5 different mutually owned life insurance companies. And would you believe that they all have a different loan interest rate? The one, which I mentioned, has a 4 in front of it. Another 1, 2, 3. Another 3 of them have a 5 with a under 5.5% interest rate on them. And then only one of them has a higher interest rate at, I believe, 6.5, but they're moving down. So just in full transparency, trying to help you understand it. So I'm just hypothetically using 5%. I'm not saying that's going to be your rate, and I'm not saying 5.9 is going to be your dividend crediting rate. This is just an example. So we're going to borrow from the insurance company at an interest rate of 5%. A lot of people struggle with this part of the infinite banking concept because they're like, it's my money. I worked for that money. I saved that money that I put into this whole life policy. Why would I have to pay interest to use my own money? And listen, that is a very logical question because at first, like when you first hear about that, you're like, yeah, why would I pay interest to use my own money? That sucks. But does it? Let me ask you this question. If your bank paid you 2% on your money in the bank, but you could go into your bank at any time and borrow at 1.5%, how many of you would pay cash for things? So I think all of you would borrow at 1.5 if you made 2. So let's come over here. If you made 5.9 and you only had to pay 5, wouldn't you borrow money from the insurance company? Now, I'm not saying this is what your numbers are going to be. I'm just making an example. You would, right? You just said you would with a bank. You would always borrow. And that's exactly the whole point. If you're earning 5.9 dividend crediting rate gross on your money, no matter how much money you have in there, that money never stops earning. Therefore, what we talked about earlier, you never ever lose the opportunity cost. There is no opportunity cost lost because your money never stops earning. Your money continuously 24/7 earns uninterrupted compounding interest. See, this is what the wealthy families understood. This is what the banks understand because banks are the number 1 purchasers of life insurance in the world called BOLI. It's basically a whole life policy. They're the number 1. Ask any banker. They know what BOLI is, bank-owned life insurance. So again, we're not all that smart. We were just like, oh, hey, wait a second. Why are the banks buying so much of this stuff? Hey, wait a second. How come all the wealthy families are doing it this way and I was told to do it that way? And these wealthy families own banks and they're telling me to put money in their bank when they're putting money in insurance companies. Wait a second here. See what I'm saying? You start questioning things. Some other things just real quick before we keep going, you should be questioning. Why is it that Michael Burry, the guy that The Big Short was made on, why is it that he's selling everything? What does he know that you don't know? Why is it that Warren Buffett's sitting on almost $400 billion? What does he know that you don't know? You see, we could play that game all day long. What do they know that I don't know? Well, now you know what they know. They're earning uninterrupted compounding interest. They don't want to lose the opportunity cost, so therefore they found a way not to lose that. And they also wanted to be the bank, so they wanted to make a spread. And again, just simple math. If you made 5.9 and you were charged 5, you would have made a 0.9% spread. Now, again, I'm not saying that's what you'd make, but I'm just trying to paint the picture. So now, why would we borrow money from the insurance company? Well, because you'd be stupid not to. In this sense, over time, the math proves it, and the Vault software 100% mathematically proves that it will always make sense. Now, there are some rules, and I do want to point out some rules, and these are pretty simple, hard, fast rules. And I'm going to go back to the traditional bank. If a traditional bank paid you 2% on your money, but then that traditional bank charged you 5% to use your money, would you take your money out? No. So if you earned 2, but they charged you 5, you wouldn't take the money out that way. You would just take a withdrawal. You would take a loan. So the same idea is the first rule. If the insurance company charges you 5, don't ever take the money out unless it can earn more than 5%. This is simple, right? If the insurance company's cost for you using their money is 5%, make sure when you take it out, it earns more than 5. So let me put that into use case. If you had debts with Visa and Visa was 20% interest, would it make sense to borrow at 5 to pay off a debt at 20? Oh, yeah. What would you make? 15-point spread. Okay. If you had a car loan that was at 6% interest and you could borrow at 5 to pay off the 6, would that make sense? Yes, you'd make 1%. If you had a line of credit that was at 8%, you see, I'm boring you now, but you can see 8 is more than 5. So all of these would qualify. Now, let me go one step further. You bought a car from GM. They had a promotional rate. So this is a GM car that you bought, and you got a promotional rate at 3%. Would you take money out at 5 to pay off 3? This is kind of a trick question, but let's just say no, because it keeps it simple. You see, these are the rules. These are the simple rules. Now, let's keep going. Now, I want to get into the recaptured part, because here's the historical context. Remember before I was talking about history and talking about who uses this. The historical context of this is before commercial banks dominated the industry like they do today, families financed everything internally. They did. This is what happened. Families did all their internal financing. When somebody wanted money for something, the family, typically the parents or the father or mother, would lend money to the kids, and the kids would pay interest back to the family. Sometimes interest, sometimes not. Brent Kessler does this all the time with his kids. Not only that, businesses retained pools of capital, because that's how they operated. That's how they grew. They needed capital, so they would create pools. They would call them war chests or reserve accounts. Okay, and I'm not saying companies don't do that today. And mutual insurance companies were foundational to generational wealth. Now, it's kind of a weird period of time, but many of you have grandparents that are in their 80s, right? 70s or 80s. Go back and talk to them. They have lots of wisdom. Go back and talk to them on how back when they were kids or with their kids, they bought whole life insurance policies for their children when they were young. This wasn't because they were being sold whole life. This is because this is how they taught generational wealth. This was just a normal thing. This wasn't an outside the box kind of thing back then. This is just what they all did. Large corporations still do this today. They don't pay cash, okay? They finance things internally. Big companies do this every single day. You see it with NVIDIA, and you see it, the little circle with NVIDIA, OpenAI, and all those. Yeah, they're just all financing one another. They really are. But let's keep going, because I'm probably boring some of you. So over here, we got the rules. The rule is if it costs 5, you have to make more than 5. So what we would do is we would capitalize our banking system with our savings, changing where it goes. We would then take a loan from the insurance company, and that loan would then allow our money to continue earning interest. So we'd take the loan, and then we would use that loan to go work for us to make a spread. We would pay off Visa. We would pay off the car loan. We would pay off the line of credit. We would pay off all those debts. When all those debts are paid off, or any of them are paid off, because sometimes this happens in just small bite-sized pieces, what we would do is take the money that we used to pay to Visa, the car loan, the line of credit, or whatever you have. I'm just going to erase GM. Okay, we would take the money we used to leave or lose, the money that used to leave our family, and we will redirect that money back into our banking system, recycling and recapturing the money you were giving away, but not just the money you were giving away, the interest rate you were giving away. Now, here's the neat thing, and I always like to show people how to do this. Most of you should know how to do this, okay? So if Visa was 20%, I entered 20 in my calculator, okay? The car was 6%. The line of credit was 8. Add them all up, that's 34. Divide it by 3. Your average interest rate that you are giving away in this scenario is 11.33%. That's your average that's leaving your family forever. How many of you have ever done that? How many of you have ever averaged up your debts to figure out how much interest you're giving away? Has anyone ever done that? Okay, I would love all of you to do that. Sometime today after this webinar, just go in and just pencil down all your debts, interest rates, add them all up, and divide them by the number of debts. You'll be really surprised. Now, let's just go and use this. 11.33%. First off, let's count rules. Is that more than 5? Yes. We're making about a 6.33% spread. Okay, so that is a very, very good spread. Even a banker would say that's a hell of a good spread. But it's not about the spread. Let's talk just relevance of 11.33%. How many of you made 11.33% on your 401k? Put I, or either 11.33 or more on your 401k last year. Put I in the chat. There's probably going to be a lot of you. We've been in a pretty good bull run. Tara says no. Maybe you should work with PMC Wealth. That's awesome. Deborah said my 2 largest debts are interest free. You wouldn't pay those off. In most cases, anyway. Okay. So I love that answer. Cynthia said, not sure. So that's good. And Cynthia, a lot of people don't know what they made on their 401k. A lot of people don't even know what their 401k is invested in. A lot of people don't even know what a 401k really is. It's just, my boss or my employer said I should put my money in there. Matter of fact, they didn't even ask. They just took the money out of my paycheck and put it into my 401k retirement plan. I have no idea. And if you were asked what you're invested in, I don't know, whatever they put me in. I mean, literally, like, that's a very common place in today's world. That's freaking messed up. That we have literally gone so far down this uncontrolled rabbit hole that we don't even know where our money's going these days. Welcome to 2026, because that's the norm. But here's the thing. I will tell you that 11.33% is a pretty darn good return. And I think all of you would agree. And a lot of you, not all of you, but a lot of you would take a lot of risk with your money that you take a lot of risk with your money to make 11.33%. But let me just reframe this. This is the infinite banking concept. I'm showing you how to recycle and recapture. But how much risk did this involve? Anyone want to figure that out? How much risk did this involve? Was there any risk by changing where your savings went and putting it into the whole life policy? No, it was guaranteed. So the only risk is in the first couple of years. If you canceled the policy, you could lose money because of the cost of insurance. But that's your only risk, because you can't lose money over time in a whole life policy. It's near impossible. I think it actually is impossible. I'm just trying to cover my butt from a compliance standpoint to say it's near impossible, because I'm sure somebody somehow can cop the way to figure out how to lose money on a whole life over a period of time. I don't know how you do it, but I'm sure somebody, if they tried hard enough, could figure it out. So it's a guaranteed system. Is there any risk in paying off your credit cards? No. Is there any risk in taking the money you were paying to the credit cards or the debts and paying it back to yourself? No. Just redirecting funds. It's just changing the process. So in this equation, you had 0 risk, but you made 11.33% on your money. It is. I've had people challenge me on this. I've had other people in the industry be like, you can't tell people they made 11.33. I'm like, why can't I? What's the difference? If they were giving away 11.33%, and now they're no longer giving that 11.33% away to somebody else, but they're paying it back to themselves, why is that not the same as making losing 11.33% or making 11.33%? It's all the same thing. It's the same dollars. It's the same math. It's just you're paying the payments back to your banking system. And here's the cool thing. Remember I said in this equation, and then I'm going to kind of bring this full circle and bring Craig on. In this equation, which is what probably, I'm going to say 95% of everybody out there does, but it's probably more like 98%. I'm just going to put an asterisk here for compliance. Remember here, you did the same thing. Your savings went into the bank. Wasn't your bank though. You then moved your savings over to pay your debts. Your debts then took the money and it was gone. Here, all the same thing, but you changed where the money went first. You did the same thing. You paid the debts, but then you didn't lose the money. The debts were paid off, and now you take the money and you recapture back over here to now every penny of the money that you recaptured, or every penny of this 11.33% is now back in your banking system that can be used the next day. The only thing you had to give up, and you didn't actually give anything up, is you had to pay the insurance company this interest rate, which, remember, you followed the rule. The interest rate was, if it cost you 5% to use the insurance company's money, you have to earn more than 5%. You followed that rule. So because you followed that rule, you made a spread of 6.33%, but you didn't just make 6.33%. That isn't what you made here. Because a lot of you were thinking, oh, that's not bad. I made 6.33%. That's good. But you actually made 6.33% plus whatever your policy earned. Now, I'm not going to say your policy at every stage makes 5.9. That's the gross. But what you netted is what we're going to show you in the vault. So with that being said, Craig, are you with us?
Yes, I'm here.
All right. So you've been tracking everything I've been saying here.
Oh, yeah.
And I did a really good job of not using numbers, which is very hard for me to do. I always like throwing up, oh, if you had 10 grand here, but you notice I did not do that. I used interest rates, but I didn't use numbers because I wanted to save the best for last, which is you showing people how the vault will do all of this for them. We'll automate this process. We'll become the operating system or the GPS. That's why I told them they have to buy the vault. So can you just take it from there and just show people what the vault does to allow them to recapture the wealth? So show them what the vault will do for them and why the vault is not an optional thing. It's a mandatory thing they need in their family.
Absolutely. And Chris, there's a couple questions I think that we should hit before we jump into that. And I saw it scrolling by a couple different times. Somebody said, "Isn't this the same as using a 401k?" So I don't know if you want to hit that real quick. And
Yeah.
then there's another question that came up. What if the insurance company goes out of business and dissolves? So if we can address those two things, then I jump into the vault and I'll show some of the math and numbers.
Sure. It's simple. So let's just say over here, this wasn't your banking system. Let's get rid of all this stuff because everything else is the same. And let's just say this is your 401k. So there's a couple things we have to understand if you do this from your 401k. Number one, your 401k has to allow the loans. Okay, not all do, but let's just assume most of them do. If they do allow loans, they will allow you to take a loan for 50% of your balance or a max of $50,000. So unless all your debts are less than 50,000, that's partly problematic. Let's just assume all the other things are the same. You could borrow from your 401k, which usually you can, up to 50% or 50,000. Let's just pretend the interest rate is the same. You took the money from your 401k, you paid off the debts, you took the debts money that you used to give away and you rolled it back into your 401k. You're doing pretty good, right? Not only that, the insurance, this is a cool thing. So although the money you took from your 401k is not still earning interest, the insurance company, when they charge you interest, that interest the 401k provider gives you the interest back. That's kind of cool. So in a 401k, in the insurance company, they charge you the 5%. You don't get that 5%. That goes to the insurance company. That's a profit item. But remember, you share in the profits of the insurance company. But in the 401k, it's required that the loan interest on the loan you took goes back into the 401k. So that's cool. So whatever the loan interest is what you're paying yourself back with interest, which is a really good thing. So you get the interest plus what you are recapturing. The downside to this whole equation is the rules. With the 401k, remember, not just these rules, but there's lots of other rules. You don't get to pick and choose how much you pay back to the 401k. They're gonna make you amortize that. They're gonna give you a period of time you have to pay the loan back. Secondarily, the other rule is if you quit or leave that employer, chances are they're going to call the loan. You have to pay that loan back, or they're going to kind of give you a specified shorter period of time. So again, the big difference is the rules. But the other big difference is your money is not earning uninterrupted compounding interest, because if you took the 50 grand out, it's not earning anything. Your money left the investments and went out to pay off your debts. So the only thing you get is the interest that they charge on that loan, that goes back in. But you can make way more with the policies than you can with the 401k, and you have less rules. So I love that analogy. It's a great one. And we teach that all the time. I've got one of my best performing YouTube videos shows how to use your 401k and the infinite banking concept. So that was a really good one. The second question was, what if a company, the insurance company, goes belly up and defunct? So to date, up to today, there has never been a mutually owned life insurance company that has gone belly up or gone defunct where any policyholder has lost one red cent. It has never happened, not with mutuals, and I don't even think with publicly traded up to this point. In the future, that could change, but insurance companies, first off, there's state guarantee funds, okay? And then there's a federal backstop as well. And there's an interesting case right now going on with an insurance company called Phoenix Life that we're kind of writing the future. So Phoenix Life went through rehabilitation. They don't have enough assets to cover their liabilities in the future. The state kind of started looking at them, and the first thing the state was going to do is sell that insurance company to the other insurance companies in that state. But when they unwound it, they saw that like there was too much liability with that insurance company, so none of the other insurance companies wanted to buy it. So writing history now. But up to this date, there's never been a policy holder or policy owner who has lost any money if the insurance company went belly up. But mutually owned life insurance companies, you can Google it, AI it, ask, how many mutually owned life insurance companies have gone bankrupt or insolvent? You might find 2 in history. Then go to AI and say, how many banks have gone insolvent in the United States? You're going to have pages upon pages. There we go.
All right, very good. I think we've covered most of the questions. And so if anything else pops up, Stephen, just keep an eye on them, and I think we'll get to go. All right, we got about 15 minutes or so. So I'm going to run through an example in the vault on debt, exactly what Chris was talking about. So let me share out my. All right, for anybody that is going to follow Chris's instructions, which is go to the vault and subscribe, we'd love to have you part of the community. And when you go to the BYOBvault.com site, you'll see a couple of videos out here that you can go check out on your leisure. You can kind of play around with a demo. But for anybody interested in joining us, there's a few different plans. The Debt Blaster plan, really what that's about is if you have debts and maybe just doing velocity banking, that's your place. If you're doing any sort of debt tracking, using infinite banking, using velocity banking, that's the portfolio plan. But there's other things inside of the portfolio plan that you won't find in the Debt Blaster plan. There's loan management, policy tracking. We have a investment tool coming out really soon, so that's going to be really cool. So anyway, they just want to give you some guidance on where to find the information, how to sign up. Now, with all of that said, let's jump into the vault and going to this Debt Blaster. I've got a plan here I call the Debt Blaster trifecta, and it goes through and shows you what is the most efficient order and sequencing. So Chris, you kind of talked about that earlier, whether you're using the snowball, the avalanche, cash flow index, those are all just strategies on how you order your debts and how you're going to pay them off. And what a lot of folks do in that 95% that Chris was talking about that just put their money in the bank and then go pay their debts, the money's gone forever. They also have kind of a common way of paying off debts. And so let's just say, for example, someone has a personal credit card at $2,500 and they're paying $75 a month on that. Most people in that 95% group, when they're done paying off that $2,500, they take that $75 and go buy more stuff or go out to eat more often. It's just, it frees their cash flow up to go do other things. They're not actually taking that $75 and adding it into the this next debt and snowballing or avalanching those debts. So what's the first thing we do? Well, we get into the vault, we put all of our debts in here. It's going to automatically organize those into the most efficient order mathematically of what's the fastest way of getting out of debt and what's the least amount of interest I'm going to pay. So here we have $78,400 of debt. And Chris gave everybody the challenge of go in and figure out what your average interest rate is. Well, the vault tells you what that is. It's actually a weighted average. Because if we're paying a lot more on a 24.9%, it may not mathematically come out just by doing an average. But this will kind of tell us we're on average about 8.66 across our whole debt profile. You'll see some things in here to 2.79 to 2.89 all the way up to 24.9. Then we total up how much are we actually paying every month in debt. So 1,265 in this particular debt profile. All right, so now once we have all of our debts identified, what we can do is jump down into this payoff strategy comparison. So if we were to do absolutely nothing in terms of strategy, we're just going to pay these debts off one by one and let the money go out the door. It'll take 181 months to pay off that $78,400 of debt, but you're also going to throw on another $30,000 of interest. So when we show this to people, the first question is, do you really want to stick with this and be locked down to this debt for 181 months and pay $30,000 of interest? Most people will say, well, no way, I want to do something better than that. So if you look at the snowball, the avalanche, or the cash flow index, those are 3 common methodologies used on how to order your debts. And so the snowball is lowest balance to highest balance. The avalanche is highest interest rate to lowest interest rate. And then the cash flow index, what it's doing is taking the balance of the debt divided by the payment And it's coming up with an efficiency score and trying to help you figure out how to get out of debts the most efficient way. In this particular debt profile, now yours might be completely different. You might actually get the snowball or the cash flow index. So this one's saying the avalanche is most efficient. It's 80 months versus 81, so sometimes these are pretty darn close. But why we're picking the avalanche is instead of paying 22,875, you save a little bit of money by organizing these debts in highest interest rate to lowest. Now, if you want to do the snowball, no problem. If you want to do the cash flow index, it's just mathematically showing you which is the most efficient way. All right. So if we were to just do the snowball or the avalanche, in 80 months, where are we? Well, we got rid of our debts, but we haven't built any wealth. We still have nothing in our pockets. And this is where we are still at risk for the next emergency that comes up, the next, major thing that we have to pay for. If we don't have the cash built up, where are we going to go to solve that emergency? What's going to happen to our situation? We're going to go right back to swiping the credit card. We're going to have high interest. We're going to go back into debt, aren't we? So the question is there a better way of doing this? And this is what Chris was talking about in that diagram. Let's just say, for example, you've had a strategy call with our team. In that strategy call, we've gathered your debts. We understand the payment structures, the interest rates. And we also understand your cash flow because we always want to be looking at what is your cash flow, what's your income, what are your expenses, what do you have left over at the end of the month, where are you putting savings? So we want to understand your situation. But here's what we can do. If we decide that, hey, you might have $500 a month, and let me just switch out here. Let's say that you're going to put $500 a month into a specially designed whole life policy. So we used to put our $500 a month into savings. All we're going to do is flip the switch to say now that $500 a month is going into this specially designed whole life policy every month. $500 month one, $500 month two, and so on. We're just going to keep doing that over and over and over. Now, if we're doing that, we're building up equity or we're building up cash value inside of that policy that we can leverage. Don't forget what Chris said. When we're putting those dollars into that policy, they're going to continue to compound and grow regardless of whether we're using it or not. So we might as well leverage that to help pay off these debts. So what we're going to do is every quarter, so I don't recommend taking loans every month. It's just tedious on you, and the insurance companies don't really care for the monthly transactions of loans. So let's just say we're going to take the maximum loan every quarter. And we're going to take that loan proceed and throw it at the debt that's at the top of the list. So we're going to be highly focused on this order, saying we're going to first go after this, then we're going to go after this, and we're just going to work our way down through that list. Now, once we've designed the policy, we're ready to do some modeling and valuation. We're going to hit this Activate Cash Value Boost button. That's going to take us down to this payoff strategy table. Now, remember, we talked about the no strategy. We're going to pay almost $108,000 to get out of debt. If we just did the snowball, we'd pay about $101,000. So we made some savings and we increased, we carved out some time. But look at this infinite banking concept strategy. Let's just walk down the columns here. So 56 months, what does that mean? It means in 56 months, all of those third-party debts are gone. They're off the list. We've essentially refinanced those into our own banking system. So we've paid some of them off, and the rest of it goes into our infinite banking concept system. So in 56 months, you no longer owe money to the personal credit card, the business credit card, the car loan, the student loan, all that stuff's gone. But we have created a debt inside of our policy. And what we're going to do is take that exact same 1,265 and run it back into the policy. So remember in that picture Chris had? And matter of fact, Chris, I've got a quick picture here. I thought you'd enjoy this.
Oh my gosh, that is freaking awesome.
So,
wow.
That's a good one.
I look like I need to lose a little bit of weight there, though. See that bulge in my belly? I've got rid of that with fasting. So
that's AI. AI put a little weight on you. I don't know why, but all we're talking about is putting the funds into our savings, which is our specially designed whole life. We're running that over into pay the debts off. Then we're going to recycle. So remember that picture Chris drew on the board. We're just going to keep going in this circle. So what we're doing in that 22 months is that bottom half of that recapture. We're taking the 1,265 that was going to the debts, and we're just simply running that right back into our own policy. So about 78 months, we're done with paying off our third-party debts. We've filled up our policy, and we're done. We're done with the debt cycle. Now you've got $1,265 of free cash flow. What are some things we could do with that? Well, maybe start more policies. Maybe you have a policy on the husband and now we're going to put one on the wife, or maybe we have one on the husband and wife. We're going to start some more on the kids. So this is $1,265 of freed up cash flow. But here's where it gets exciting. Instead of paying $30,000 in interest in the no strategy or paying $22,000 of interest in the debt avalanche alone, we've now paid $17,352 of interest. So we reduced our interest cost. But look at this, at month 78, because we're, in 78 months, we're done paying our debts off. In this particular policy design, there's over $35,000 of cash value built up and a death benefit of $169,000. So who do you think is going to be in a better position? The person that just did the debt avalanche, or the person that simply changed where their money's going and use that cash value to accelerate paying off the debts and then recapture? So let's say in 2 months, an emergency comes up and I need $10,000. Where can I get it? Well, don't I have close to $35,000 of cash value that's in my own system that I can use? What if I use that $35,000 to start investing in my business, or I used it to build more, cash? If I put it in my investments and I'm making more in that positive arbitrage. So that's the real question. Which one of these strategies do you want to do? And so we just simply mathematically prove it out. Once we put your numbers in, run your policy, and we can show the economic benefits of using the policy. So somebody had mentioned, someone in the comments earlier, about, Chris, are you trying to sell whole life policies to us?
Oh, well,
And
not selling you anything. You don't need the whole life to do infinite banking, but if you just understand the mathematics, you're not going to want to do it without the policy.
yeah, and this is why we teach what we teach, is because we've run the math and there's an economic benefit to using the specially designed whole life policy to take back those banking functions, and you're in a way better position down the road with getting out of debt and building cash value. So those are the things we want to get people into. And then at the end of the day, you can go down to the detailed payment table and you can see a month by month of what you should do. Now I've got my start dates all messed up, but let's say we're starting in November of 25. This whole cash value boost column is just going to tell you when to take a loan from your policy. So every quarter, if we start here, we're taking a loan in March, and then we're taking another one in June, we're taking another one in September. And if you look across the board, you're just going to say, okay, I'm going to take this extra and I'm going to apply it towards that personal credit card. The reason we're applying it to that personal credit card is that was the most efficient order to get us out of debt faster. So we're simply taking that chunk and throwing it at the personal credit card. And then you can see 125 a month goes to the business credit card, 180 to the personal loan. And we just keep operating this way until you'll see down here, the personal credit card's paid off. Now we take that extra and we start throwing it at the business credit card. And we just keep doing this until we're all said and done with all of the debts. And what we'll do in those strategy calls is, you need to come prepared, or maybe we get it ahead of time. We want to know, if you're a person that has debt, what are those debts? So we can get it structured in here, and then we can look at, what's your debt cycle look like, what's your cash flow, and there's a velocity banking component to this too. We're not going to go over that today, but you can see that in some of the demos. We could talk about that on strategy calls. But really what we want to do is build out a profile of understanding what are your income sources, what are your household expenses, because ultimately what we're looking for is what your income, what are your expenses and debts, so we can understand your cash flow. And once we understand your cash flow and what some of your assets are, then we can have a conversation around, does it make sense to take some of this cash flow, put it into a policy, use that for your debt cycle? So there's a lot of different things we may discuss on a strategy call based on your specific numbers.
Yeah, and hey, Craig, I just want to make it clear, for anybody that's on here watching this, if you feel like this is like overwhelming or a lot, like you don't have to do any of this part. Just book a call, watch the 90-minute infinite banking training, book a call and talk with our money mentors. If you want to get real in depth and you really want to dig into all of this with us, we can do that. If you just want to ask general questions and find out if this is even right for you, if infinite banking is something that you might consider without like getting into all this detail, that's perfectly okay as well. I mean, just for me personally, I have multiple policies. I've been doing infinite banking for years now, and I do not have this real complex structure set up in the vault because at this point I haven't needed it or dug in that deep to it. So there's different levels to all this, just like everything in life. So I just don't want to scare anybody away from, not just scheduling a call because they don't have all their debts lined up yet, or they don't exactly know what they need yet. Just schedule the call and let us talk you through it, right?
Yeah. So, what we want to do is after you get that call, we answer your questions. The way I work specifically, I'm all about modeling what you're trying to do, proving it out, and then we implement it. So, and that's what the money mentors will do, is walk you through all this. So it's not something that you're just responsible for dealing with on your own. So there's some work to be done to gather your numbers, and that's going to be something you're going to need to do, is provide us the information. Then we can help and work in conjunction with you to get a plan that's going to work best for you. Um, so Chris, with that, I know we're at time. So just want to see, is there anything else you want to try to cover or any questions that we need to
No, I think just hitting
address?
the obvious, the Vault software, you guys do a training, you and Marius, every week called office hours. They kind of
Yeah.
teach people how to use it. People can jump on a call with the mentors to kind of walk through their scenario in the Vault. Yeah, there we go, cracking the Vault. Yeah, I always call it office hours, but cracking
Yeah.
the Vault. But the most important thing is, if any of you think this would help your family, this would help your situation, if you want to become your own bank, it starts with booking a call. That's where it always starts. I mean, there's a human relationship that we need to build. We need to understand your needs and goals. We need to understand your unique situation. And, just in the 130 people on here in the chat, there's probably been 50 different scenarios that have popped up just in this short hour and a half that we've been on here. So we want to understand your needs and goals. We then want to, show you, because I already told you to buy the Vault, so you'll have the Vault on the call. Or if you don't, we'll get it on the call. We'll show you how the Vault will operate this for you. And we then, if you do it in that order, we then could build the information, your debts, whatever it is you want to do, into the Vault, so that when you are done and your policy is issued and funded, your Vault is built in. You already know your roadmap. And then literally, like, let's say it's to pay off debt. Use this example, Craig, just click on the GPS. So go down and we build all this in there for you. And literally, this is what you need to do. So you literally start month 1. Great. It tells you what to do. It just every month, you just click the little arrow and it tells you exactly what to do. And we're there step by step. Like I said, the cracking the Vault is an every week training we do at the Vault. And we're always here to help, our clients after they're there. And there's a lot more of this coming. And just so you all know, here's one thing I am going to say. Another reason why I said you all need to buy the Vault, and I didn't say, hey, if you want the Vault, I said you need to buy the Vault software. Here's a reason. Remember I mentioned, Warren Buffett may know something you don't know. Michael Burry might know something you don't know. I know something none of you know. There is something we're building into the Vault that's going to be freaking wild. Matter of fact, we already have a sample of it. We've already been testing it on the back end. It's an AI interface on the front end. So in other words, like when some of you look at this, like this looks confusing. There's like, oh my God, there's a lot of tabs. I wouldn't know where to start. I wouldn't know what button to click. Great. What if you didn't have to? What if just like ChatGPT, just like Gemini, just like Grok, just like Google, you just have to tell it what you want. Hey, I want to structure a loan to pay off my debts the most efficient way. Boom. And then what if it just did it for you? And it just asked you, okay, just like ChatGPT, when you ask ChatGPT to do something, if you didn't give it the info, it's going to ask you for it. Like, hey, you want to pay off your debt, but you got to tell me what debts you want to pay off. Can you enter your debts? Give me this, 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 this. It will tell you that. Now, this AI interface, And then there's another thing that we're going to be doing, but I'm not going to tell you about that because it's super freaking cool. This AI interface, when we include this in the vault price is going to go up. Okay. I'm just being honest. The portfolio plan is not going to be $490 a year. So that is coming. But if you buy it now, when we do that change in price and add the AI interface, everybody that's in there is going to be grandfathered for at least no less than 12 months. And it could even be longer at the original price. So I don't know what we're going to price it at with the AI interface, but it's going to be more than it is today. So if you buy it now, you lock that price in, and we will not increase it when we add the AI interface, which is probably no more than 3 months down the line. So if that's not enough incentive to buy now, well, then you're never going to buy. So I don't know what to tell you.
All right. Well, it's
Maybe
I
that
don't know
was
if there's
just
any-
Frank is telling you got a booger hanging out of your nose. Hey, Craig, you got a booger on your stash. I'm just kidding. Let's see.
Well, I appreciate that.
What day, somebody asked, what day is cracking the vault?
So
Oh, no, never
cracking
mind.
into
You already
the,
answered that. Holy cow, you're fast.
yeah.
Rebecca said, so if I do this for a parent, does it use my cash flow on the strategy call or her cash flow? Rebecca, that would be both. So we would use both. You're welcome, Frank, as always. Thanks for being here. And K8 full, I think it is. What if you have no consistent income because you are a full-time investor? Will this work for you if you have no hard set salary and you trade and invest? So you're a day trader. That's awesome. Yes, we have lots of day traders. But here's the most important thing, K8. This is the most important thing you need to understand. If you have an inconsistent income, you need to build the policy with a very low start. So let me just kind of show this. So let's just say, I'm just going to use round numbers. Let's say your target income is 10,000, but there's some months where you only make $1,000, right? So what you would want to do is you'd want to build a policy that has thresholds. Now let's just use this. We could, now I'm not going to say it's going to be easy, but we probably could build a policy that has a minimum of in this case, of 2,000 and a maximum of 10,000 if you wanted. We could build a policy that has a maximum of 1,000 a month and a minimum of 150 a month. So we would need to, for someone like you, make sure we create a lot of flexibility into your plan design so that you have that ability to kind of float from a low to a high. Now, here's one caveat. You'd want to try to make sure you had at least 1 full year's premium deposit to make. For example, if you did a policy, and I'm just using round numbers, these aren't numbers for you, of just picking simple things. You want to do 1,000 a month. You'd want to make sure that you have enough to do the first $12,000 for the first year before you get started. Because if in the first year you started at 1,000 and then month 2 you need to go to 150, you're gonna really affect the policy. It's not going to perform well. You're going to really hurt the policy. So the simple rule we have is make sure you've got at least 1 year's premium deposit at your maximum funding, and then we can build that flexibility in. I think that's great. Well, hopefully this was beneficial for all of you. And Craig, thank you for showing the vault. Stephen, thanks for chiming in on that and taking care of all the comments and questions. And just big thank you to each and every single one of you for joining us for Wealth Webinar today. We hope you got something out of it. We hope it was something tangible, gave you 1 or 2 really good actionable ideas, like number 1, buy the vault now. Number 2, book a call with the mentors. And maybe number 3, hey, I need to do something. So I hope you got something out of this that you can apply in your life to have tangible change for the better. With that being said, folks, thanks so very much for joining us, and make sure you check us out this afternoon, 4:30 Eastern, for our Brady Bunch Ask Me Anything happy hour. We'll see you at 4:30, and until then, have a good day.